Pte Ltd, or simply OA, a Singaporean company, entered into agreements with several Malaysian companies. These agreements granted OA the right to use certain technical information and processes. This information was crucial for the Malaysian companies to construct and operate a refinery and a methanol plant. OA was to receive payments for these rights. These payments were calculated based on the output of the refinery and the plant. OA also entered into an agreement with Pernas, the National Oil Corporation of Malaysia. This agreement pertained to the provision of technical advice and assistance. Pernas was a shareholder in the Malaysian companies with which OA had agreements. The relationship between OA and the Malaysian companies, intertwined with Pernas's involvement, formed a complex web of agreements. This complexity led to a significant legal dispute concerning the nature of the payments received by OA. The crux of the matter was whether these payments constituted royalties taxable in Malaysia or business income taxable in Singapore. The case of Pte Ltd v. KPHDN 1996, MSTC 2286 revolved around the taxability of payments received by Pte Ltd from Malaysian companies. The key issue was whether these payments were royalties or business income. If classified as royalties, the payments would be deemed sourced in Malaysia and subject to Malaysian tax. This is because royalties are generally treated as arising from the country where the intellectual property rights are used. However, if the payments were considered business income, their taxability would depend on where the business activities generating the income were carried out. OA argued that the payments constituted business income derived in Singapore. They based this argument on the fact that their primary business operations were conducted from their Singapore office. This included the development and provision of the technical information and expertise. Conversely, the Malaysian tax authorities argued that the payments were royalties. They contended that the payments were directly linked to the use of OA's intellectual property rights in Malaysia. This classification would subject the payments to Malaysian tax. This disagreement on the nature of the payments and their tax implications formed the heart of the legal dispute. The case highlighted the complexities of international taxation, particularly in determining the source of income and the applicable tax jurisdiction. The Special Commissioners of Income Tax in Malaysia adjudicated the dispute between Pte Ltd and the Malaysian tax authorities. Their judgment hinged on the source of the payments received by OA. They ultimately ruled that the payments were derived from Malaysia. The commissioners meticulously examined the agreements between OA and the Malaysian companies. They found that the payments were intrinsically linked to the use of OA's technical information and processes in Malaysia. The fact that these payments were calculated based on the output of the Malaysian refinery and methanol plant further solidified their decision. The commissioners acknowledged that OA had undertaken business activities in Singapore. However, they emphasized that the source of the income was not determined by where OA conducted its business, but by where the rights granted by OA were exploited. In this instance, the rights were utilized in Malaysia, leading to the income being sourced there. This judgment underscored a critical principle in international taxation. The source of income is paramount in determining its taxability. The case illustrated that income can be deemed derived from a country even if the business operations are conducted elsewhere. This is particularly relevant for income generated from intellectual property rights, which are often exploited in countries different from where they are developed. Section 4, accrued versus derived, a vital distinction in tax law. The Pte Ltd versus KPHDN case highlights a crucial distinction in tax law, the difference between accrued income and derived income. While often used interchangeably, these terms hold distinct meanings in a tax context. Accrued income generally refers to income earned but not yet received. For instance, if a company provides a service in December but bills the client in January, the income is considered accrued in December, even though the payment is received later. Conversely, derived income refers to income received or realized. In the context of Pte Ltd, the income was deemed derived in Malaysia because that is where the rights granted by OA were utilized, and the payments were directly linked to the output generated from that utilization. This distinction is crucial in international taxation, as the timing and location of income derivation can significantly impact tax liabilities. It underscores the importance of carefully scrutinizing agreements and transactions to determine the precise point at which income is considered derived for tax purposes. Section 5. Lessons from Pte Ltd versus KPHDN, Understanding Income Derivation. The Pte Ltd versus KPHDN case provides valuable lessons for understanding income derivation in international tax law. It underscores the principle that the source of income is paramount in determining its taxability, not necessarily the location of the business operations. The case highlights the importance of carefully analyzing agreements to determine the nature of payments and the source of income. Factors such as the nature of the rights granted, the location of their exploitation, and the basis for calculating payments play a crucial role in this determination. Importantly, Pte Ltd versus KPHDN underscores the need for businesses operating internationally to seek expert tax advice. The complexities of international tax law, particularly in determining income derivation, can lead to unforeseen tax liabilities if not navigated carefully. Section 6. Conclusion. The enduring relevance of Pte Ltd versus KPHDN. The Pte Ltd versus KPHDN case remains a significant precedent in international tax law. It provides valuable insights into the complexities of income derivation, particularly in the context of intellectual property rights. The case underscores the importance of carefully scrutinizing agreements and transactions to determine the source of income and the applicable tax jurisdiction. As businesses become increasingly globalized, the principles established in Pte Ltd versus KPHDN will continue to hold relevance. The case serves as a reminder of the importance of seeking expert tax advice to navigate the intricate web of international tax law and ensure compliance with relevant regulations.